Securing institutional scale returns in physical gold arbitrage typically implies tying up massive amounts of liquid capital. But the architecture we are analyzing today executes global supply mandates without the financier ever deploying a dollar of cash. The traditional assumption in cross-border physical commodities is that securing high-volume inventory requires fronting millions in liquid cash to satisfy the seller's risk. Goldbridge operates on a different structural mechanism. We absolutely bifurcate the credit guarantee from the actual cash settlement. On the left side of this model, traditional trade finance drains cash upfront to move the physical inventory. On the right, the Goldbridge model uses a standby letter of credit, an MT-760, to lock the inventory and trigger the shipment, while a completely separate third-party MT-103 wire executes the actual payment. Notice the financier's position on the Goldbridge side. Their underlying cash reserve remains permanently full and untouched throughout the entire transit and settlement cycle. Separating the guarantee from the settlement shifts the trade from a capital-intensive physical operation to a purely credit-based architecture. Operations scale to metric tons because the volume is no longer limited by liquid cash reserves. To execute this, you need three distinct institutional entities operating in strict coordination. We have the financier, the seller, and the end buyer. The financier's role is strictly limited to providing proof of funds and issuing a banking line via an irrevocable standby letter of credit. They never actually initiate a cash transfer. The actual cash settlement is provided by the end buyer. This is a principal at a world-class refinery who wires the funds directly to the seller via an MT-103 upon delivery and assay. By executing a precise 7-step swift messaging sequence, a financier secures international commodity allocations while remaining permanently insulated from the physical payment chain. This transaction map demonstrates exactly how the operational sequence executes. The initial step establishes communication between the financier's bank and the seller's bank. An MT-760 standby letter of credit is transmitted across this channel. The SBLC functions purely as a non-funded security instrument. It legally satisfies the seller's requirement to ship by guaranteeing payment, even though zero actual currency has left the financier's account. With the SBLC in place, physical execution begins. The seller assumes all logistical responsibility, shipping gold from the origin country to the destination hub. Once the gold arrives at the refinery, it hits the assay firewall. Settlement cannot proceed without an independent final assay report, verifying the exact weight and purity of the metal. Because payment is gated by the final assay report, the financier is insulated from purity or weight disputes. Settlement is based strictly on objective third-party verification, neutralizing subjective seller claims. With the gold verified, the actual cash settlement executes. The end buyer remits payment straight to the seller's bank. Notice the routing. The active MT-103 payment pathway explicitly bypasses the financier's banknote entirely. This routing is permitted by a specific legal mechanism, a pre-authorized third-party payment clause embedded directly into the original sales and purchase agreement. Executing this requires 4 elements to align prior to shipment: the SPA clause itself, written notifications to the issuing bank, seller pre-notification to the receiving bank, and an exact SPA reference code. Because the cash physically never drops through the financier's account, their legal status acts purely as an operational anchor for the instrument, completely stripping away their transactional liquidity exposure. This data table compares the volume breakdown and pricing metrics of Goldbridge's 2 active supply corridors, Kenya and Thailand. These parameters show how the theoretical trade finance framework applies to live supply lines. Looking at the Kenya column, we see a margin-heavy economic model. The seller offers an 8.5% discount to the LBMA spot rate, yielding a net profit of $8,250 per kilogram. The operational scale targets 200 to 300 kilograms per month. This volume requires a single 1-year SBLC with a $27 million face value. Shifting focus to the Thailand column, the economic model changes. The spread is tighter, netting $6,750 per kilogram, but it is offset by massively higher volume. The Thailand corridor ships 200 kilograms daily, totaling 1,400 kilograms weekly. That continuous flow generates nearly $500 million in annual net profit. Across both corridors, these gross margins are protected. The seller legally bears 100% of the taxes, royalties, insurance, and export costs, leaving the buyer's side economics intact. To maintain Thailand's daily volume, the banking architecture must adapt. It requires 2 independently revolving SBLCs, totaling $56.4 million, running in parallel to prevent settlement bottlenecks. The supply-side economics dictate the banking architecture. Low-volume, high-margin corridors function efficiently on standard instrument holds, while high-volume, continuous flow mandates complex, parallel revolving structures. The primary operational hurdle for any financier implementing this framework is navigating their own internal bank compliance department. Before signing any contracts, the financier must have an explicit conversation with their trade finance desk. They must ask, will compliance accept me as the SBLC applicant while a nominated third-party off-taker makes the MT-103 payment on my behalf? The bank's answer to this specific question is the binary trigger for the entire operation. Without formal approval for third-party settlement, the zero-cash architecture collapses. Verifying this exact SWIFT routing exception upfront is the singular difference between executing a viable institutional mandate and entering a structurally flawed transaction. We can now reevaluate this architectural framework strictly through the lens of downside protection and counterparty risk. Consider the ultimate risk scenario. The end buyer defaults on the MT-103 payment after the assay. In a default, the fallback sequence triggers. The SBLC becomes drawable, paying the seller directly. Simultaneously, the financier recovers damages from the end buyer under a separate binding contract. Crucially, the revolving instrument structure caps the financier's exposure. Only one single shipment's live value is exposed at any given time, never the full annual program value. This architecture effectively transfers the transaction's performance risk away from the financier's personal liquidity, placing it squarely onto the multi-billion-dollar balance sheet of the refinery. Enabling this structure carries a fundamental operational cost, the annual banking fees required to issue the SBLC. This chart compares that cost against the gross annual profit. The mathematical asymmetry is stark. In the high-volume Thailand corridor, the total banking cost represents to move the inventory, while the refinery's institutional liquidity executes the final settlement. Underpinning these abstract trade finance mechanisms is the enduring physical asset itself. True institutional wealth generation in commodities does not require recklessly deploying capital. It requires expertly structuring bank credit to move physical wealth across the globe with total integrity.